everyone, welcome back to the channel of Ecoholics. So I'm going to discuss one more question from the economics optional paper of 2022. So the question number is question 5 part B. The question talks about the quantitative methods of credit control adopted by the central bank. So when we talk about quantitative methods, what are those? So quantitative methods are those methods of controlling credit by curbing, like even so if we want to control credit, that is we want to restrict the credit creation process. So we want to slow down or we want to decrease the volume of loans, the volume of credit given by the commercial banks into the market or by another financial institutions. So when we talk about quantitative methods, they consist of all those methods which are going to affect the cost of the lending, cost of borrowing, or maybe the volume, that how much can you borrow or how much can you lend. Or the third way through which we can control the credit by using quantitative method is the availability of resources. So if RBI becomes successful to control the amount available with commercial banks, that's also going to help them controlling the credit. So these are the quantitative credit controls. So let's just discuss that what all quantitative credit controls we have. The first is bank rate. What is bank rate? Bank rate is the rate at which RBI lends loan to commercial bank. So many times commercial banks take loans from RBI. So the loan by RBI is given at bank rate. So it's also known as discount rate. So if RBI increases bank rate, the borrowing by commercial banks is going to become costlier. And costlier would be the borrowing for commercial banks, the less volume basically they are going to borrow from RBI. So in this way, this is a direct method through which you can decrease the amount of availability or amount of credit available to commercial banks. So if they have less money, they would also lend less money further. So by increasing bank rate, the credit can be controlled. The next method is about open market operations. So what is open market operations? Whenever the central bank, that is RBI, is involved in selling bonds or buying bonds. So what does that mean? There are a lot of government bonds and government securities which many times the RBI either buys it or sells it to influence the credit availability in the market. So when the RBI is buying bonds, what RBI is doing? When someone buy bond, they are the supplier of money. They are the supplier of funds. Because bond is a promise you make to someone that I will return your money on this date with this interest rate. So if I'm taking bond from someone, if I'm buying bond, it means I'm giving my money. And when I'm selling bond means I am the one who is giving bond. So it means I'm borrower of money. So I'm borrower of funds. Now for controlling the credit, RBI needs to pull back the money from the market. So they want to take money from the market back. So they would be the borrower of funds. So by selling the bonds they hold on to, the government securities they hold on to, or the bills they have, they can sell the bonds, and by selling the bonds, the people are going to buy it and they're going to give money to RBI. So this way also the money can be absorbed from the market. So open market operations. The third method is about the cash reserve ratio. What is cash reserve ratio, or also popularly known as CRR? So cash reserve ratio means that out of the total deposits a commercial bank have received, what amount of money from that they need to keep with themselves as a reserve. So if, for example, the CRR is 10%, it means that out of all the deposits they have received, they're required to keep 10% of the money with themselves, that they cannot lend us 10% of the money. So how can you control the credit? So if you decrease the ability or the availability of resources, availability of funds with commercial bank which they were lending, that's how you can control it. So if you increase CRR, you can decrease the availability of funds with commercial bank, because if you increase CRR from, let's say, 10% to 12%, now they need to keep 12% of money with them. So that 2% which was going to loans earlier, that would be absorbed back, that won't be lent to the market. So in this way, by increasing the CRR, the central bank can decrease the volume of loans or the volume of credit creation process, um, in which the commercial banks are involved, because controlling credit is really necessary at the times when inflation is really high, because higher is going to be the money supply with the people, the more demand they are going to make, and hence the higher prices. So that's why we need to control credit. So with these three quantitative methods, the central bank becomes successful to control the credit. So that's all about this answer. I hope you will like this answer. You will find this video to be useful. Please share this video with your friends, subscribe to the channel, and do let us know in the comments that how much useful this video was for you. Thank you so much.